Welcome to the Contrarian Capitalist podcast, and delighted to be joined by Durrett. We spoke a few months ago and there was a lot going on then, and there is a lot going on now. Don, welcome back to the show.
Hey, thanks for having me back, Robert.
Don, I was looking through the notes for the first time that we spoke, and if people haven't listened to that yet, I'll put a link in the post that comes with this podcast. We were looking at the importance of gold being a tier one asset under Basel 3. What sort of market correction could happen in March and April 2025? We'll touch on that in a second. And then we've done a general overview of the state of the markets at the time and looked at some driving forces behind gold and silver. And then we also looked at why mining stocks appear to be unloved. Going back to that correction, so I know you went through your thesis last time. Obviously, the S&P 500 dropped down to about 48.35, I think it was. And then it's been pretty much a perfect V-shaped recovery since then. If you can, let's start with your overall thesis again, just for people that might not be familiar with that and how that links in with things like HUI, etc.
Yeah, so I'm a gold and silver mining stock investor, and so we've only had two periods where gold miners had an extended bull run, if you will. So the price of gold was $35 in 1971 before Nixon went off the gold standard. So mining stocks were kind of an afterthought, pre 1970s. But in the 1970s, we had an extended bull run in the miners. And the reason why is because it was a period of economic turmoil. And so the miners and gold, well, gold outperformed the stock market. Gold went from $35 to 800. So it severely outperformed the stock market. The miners did well, but that was for a decade. And then we had the 1990s, the 1980s and the 1990s. So we had 20-year basically bear market where gold didn't do anything. It was at $850 in 1980, and it was at $250 in 2000. So it did nothing for 20 years. And the reason why it did nothing for 20 years is because Reagan came into office in 80, and the 80s and the 90s were basically a kind of a boom time in stocks. And so the miners do not do well when stocks are doing well. And so then we had the dot-com bubble burst in 2000, and then we had a recession in 9/11. And so we had the early 2000s, we had economic turmoil, and then that turmoil manifested even more deeply in 2007 and 8, what we call the Great Financial Crisis. Mm-hmm. So you basically had three major economic turmoils from 2000 to 2008, and that led to gold going from $250 to $1,935, so we had another extended rally in gold where gold outperformed the stock market. Then from 2012, basically the end of 2011 till now, if you will, well, gold's starting up until let's say 2019. Gold basically is in a bear market. December of 2019, which is basically 2020, we had gold break out. And so gold's been in a bull market, in my opinion, since, let's say, January 2020. But silver didn't join the party until 22. And so, but it's still early innings. It's still early innings for gold and silver. And they're kind of leading for a number of reasons. Gold and silver are starting to, I would say gold is leading. Last year it was up 27%, and this year silver is outperforming gold right now for the year. But gold is still outperforming the S&P. The S&P is kind of flat for the year. So gold is kind of taking over this leadership, which is what we want to see, where gold and silver outperform the stock market. But we want to see an extended rally. We don't want to see one year, 2 year. We want to see 1970s, 2000s kind of thing. But if I'm right that 2019, or let's say January 2020 was the beginning of this thing, I think it's only going to last maybe 9 years. We're looking at 2028. 0 year, you count that as 1 year. So we're looking at like 2028, I think, is when this bull market possibly could end for gold. So we're at 25. So the next 3 years is when we really want to make a lot of money in the gold and silver mining space. And I think gold is going to go to $5,000 in the next 24 to 36 months. And if that happens, I think silver, if you use a GSR of 50, it's going to take gold, silver to $100. I think that's minimum. But I actually have raised my minimum prices to 125 because I think we're going to get um, a 40 GSR, which will take us to 125. And so I'm thinking 125 to 150 is kind of where silver's going, and gold's going to 5,000 in the next 24 to 36 months. So we're going to get kind of a condensed rip here. But the last two times that you had blow off rallies in gold and silver, they happened at the end of these rallies in 1980 and 2011. They were kind of short and condensed, where this time we're actually breaking out to a new high in gold when the miners are almost at their lowest level of valuation wise ever. So it's the beginning. So it's kind of it's a different scenario here. And the key to it all, we need this extended rally. The key to it all is the S&P 500 has to basically languish, stop growing up. And so you have this discrepancy between, where do you put your money? The stock market is doing poorly and gold is doing well. That's kind of the outcome that I've been waiting for. So a lot of people have been saying that silver's breaking out here. Gold's been breaking out since 2020, and the miners really haven't done that well overall. And so why not? And I'm basically saying because you don't have that discrepancy between the stock market and gold. We haven't seen it yet because the S&P is almost at an all-time high right now. That is not the scenario. That is not the condition where miners do well. So if people think that, silver is going to break out here, I'm going to put all my money in the miners. Yeah, I think it's going to work, but until we get that fear trade where people don't want to invest in the stock market, I mean, that's what the fear trade is. Like, I don't want to invest in the stock market. It's not doing anything. So from, into World War II, all the way up till, till 1980, the stock market really didn't do that well because there was a lot of fear. There's like, I'm not going to make any money in stocks. I mean, I think in the 1960s, Warren Buffett sold all his stocks because you weren't making any money in the stocks. And so that's what we need. We need that type of, I don't want to invest in stocks, I'm selling my stocks kind of attitude. So until people don't want to invest in the S&P 500, we're still in an opportunity to buy miners. Because when that flips, when that pivots, when people don't want to buy stocks, they're going to want to buy the miners. That's when you get that pivot. And that's when we're going to get this unbelievable, I believe, rally in miners. I mean, I can find, if I'm right, and gold goes to $5,000 and the GSR squeezes down to sub 50, these stocks are all going to be 5+ baggers. I have Newmont right now printing as a 5-bagger. That's 6x. You can take its current value of $53 and multiply that by 6. So my price target for Newmont is $300. So if Newmont's going to 300, it's going to be very strange. I mean, the mid tiers are going to do better than that. It's almost fantasy land when you value these companies, what they're capable of, what's possible over the next 3 years if gold goes to 5,000.
And I think gold going to $5,000 is obviously nothing's a guarantee in life, but I think given everything else that's going on in the financial plumbing of the world economy, I say 5,000 is a very realistic target, in my opinion. And just one thing, because I see different people talking about this online, and it 6 of one, half a dozen the other. So we've got the S&P pretty much where it was at the start of the year. So ultimately not much movement there. But when the last great buying opportunity then is when there's a broader sell-off, when there is that recession or that fear trade, as you say, I would imagine that some people will be selling off their gold and silver as well. That might suppress price for a little bit. To me, that would signal when everything's, very fearful, we might see the price of gold and silver go down. that could be the last really, really good buying opportunity before it potentially goes parabolic and we see that GSR get squeezed as well. Is that a fair assessment?
Yeah, although I don't, the last good buying opportunity, and I've been doing this for a long time, is when the HUI was down below 200. So if you look at the HUI chart, that's the gold miner chart. It was at 600, 635 in 2011. And so when it was trading sub 200, it was like these stocks were
Mhm,
all on sale. And so in October of 23, it was sub 200. So it would go up and down. It would go 275, 300, and then all the way down to 225, 200, and then it'd go back up. So you had to be patient. But whenever it got sub 230, sub 225, for me, it was like that was kind of like the buy zone. So I wasn't buying at 250, 275, 300. We're at 400 right now, by the way,
mhm,
418. But when it was sub 225, I was like, okay, buy zone. And then when it got sub 200, it was like whatever cash you have, buy everything. It was like load the boat kind of thing. So that was the last really good chance to buy was sub 200. I don't think we're going to get a great buying opportunity. I think those are all gone. But what you can do is try not to miss when the train leaves the station, because I do think there's going to be one more dip here. But I doubt we go back to 300 on the HUI. And 300 on the HUI, I mean, not too long ago, that was kind of considered a breakout level,
mhm,
because that was a 30% move off of 200. And so it was kind of a breakout move. But now we're at 418. I think that we're probably going to go back to 350.
mhm,
And I actually have not bought any stocks in this month in June. I usually do buy every month. I'm not buying because I'm waiting for this correction that I think is coming. So I think we are going to go back to 350, maybe 325. So my target is 325 to 350 on the HUI. I think that'll be kind of the last dip. But we're not going to get those very low price targets that we had in the prior corrections, because I think we are breaking out. I think we're going to have higher lows here. But you're
mhm,
right in that once this next dip does occur, I don't think we're going to go back sub 400. That this will be like the last chance, because the next when it gets above 450, I think it's kind of see you later. That's when the train has left the station. I think HUI 450. And it's like that's when everybody on the train is looking back and saying, you missed it, people. The people that, if you don't own any miners at 450 HUI, you're going to miss it. So, an example right now, I have Newmont. My target price for Newmont is $300. So, if you got in today, and I think it'll go cheaper, is it 53 bucks? I think it'll go down low 40s in this next correction. I think it'll go low 40s. At that point, it's going to be, which is kind of crazy, it's going to be like be a seven bagger if it goes low 40s, six or seven bagger. So people are like, Don, that's impossible. There's no way that Newmont can be a five bagger from here. Well, just do the math. The key is going to be the free cash flow, the margins. And there's a few keys here. Because, okay, Don, you said it's going to go, your target is 300, back that up. So I'm backing it up this way, is that I think gold will go to 3,000 within 3 years. And I don't think that the energy prices, I don't know about oil, maybe oil really bites us and we get inflation, but I don't think we're going to get significant cost pressures over the next 3 years. So I think what I'm thinking is that the margins are going to be huge. So if you have $5,000 gold, all we need is $2,000 margins. So if it goes all the way to 3,000, and I don't think it will. So I don't think it'll go much above 23, 2,400. So we're looking at $2,700 margins. So
mhm.
if you get, I think that's 2,600, $2,700 margins with my expectations. So I don't think costs are going to explode, but I could be wrong there. So the key is going to be the price of gold, how high the price of gold gets in the next 3 years. And then the cost, how fast the cost rise. And then the third factor is going to be what free cash flow multiple they get. So today their multiple is a 9. And I really believe that that nine is about 50% below where it should be at their current margins, $1,000 margins. I think it's repressed. I think it's suppressed because Wall Street doesn't want to buy any miners right now. They haven't bought any. They've been making money on Wall Street since 2009, and they have no desire to buy miners. So I think the 9 multiple is misplaced. I think they should be about a 15. And so, and I think 15 is normal. But if you get, as the margins blow out, which I think they're going to do, as the margins blow out, the multiple will expand. So I think you get multiple expansion alone, I think you go to 20, just on multiple expansion, 20. Then if you get a mania into stocks, which I think we'll get, when everybody's basically running into these stocks, they're making a fortune. Everybody wants to own them. I mean, if put it this way, the minute if Newmont does what I say it's going to do, if it's like a 2-bagger or a 3-bagger, people are making 50%, 100% on their money on Newmont. People are going to go, that's a nice stock, and you're going to get more money going into it. So that's why I'm using a multiple, I think, of 25 to get to my $300 price target. So it's not crazy talk if I hit my numbers. Now, again, those are the three things: price of gold, the margins, and the free cash flow multiple. That's what I use for how I value these companies in the future. And then, of course, you have, government taxes could go up and impact sentiment. Sentiment can weaken, but I'm banking on sentiment getting better, where people want to own these stocks. And then the other one is, you never know, they could have a problem at one of their mines. That's why I always say, you can't pick winners. So I'm using Newmont as an example, but I created a list called the Elite Eight, which are like Newmont's peers. And so if you own all 8 of those, instead of just owning Newmont, if you own all 8 of the Elite Eight, then you're probably going to average a 4-bagger. And if one has a problem, one might have a problem, but the other one might do really well. So you could diversify into 8 names instead of one. So you can find the Elite Eight on X. You just search for my name in Elite Eight, and you'll find it easily.
We're talking, for those that might not be familiar with Newmont, it's one of the biggest names in the mining space. Don, I know that it wouldn't be fair to ask you about all the mining stocks that you track, because there are a lot of them. But I know that you did say off air that there was a couple of news items that you thought would be worthy to talk about regarding a couple of companies. So if you can go into those companies that are in the news.
Sure. So Hochschild had a problem at one of their mines. It was Mara Rosa in Brazil that had flooding issues, and their production was down by 50%. And it's only one of their gold mines. So they produce, I think, about 8 million ounces of silver and 400 million ounces of gold, something like 400,000 ounces of gold. And the problem was only at one of their gold mines. Just one gold mine had a problem. The stock dropped 20% for a flood at a mine that basically will be fixed. So for this year, their profit and their costs are going to be, the profit will be down, their cost will be up. This year, not next year, just this year. And the stock dropped 20%. 20 in one day, 20%. So gold and silver mining is not for investing. It's for speculating. And this is a perfect example. I mean, Hochschild is $1 billion company. So $1 billion company can drop 20% in a single day from announcing a news release that they had a flooding problem and they had to basically shut down the mine. One little problem and you can lose 20, 25, 30% of your stock. So it's basically gold and silver is high risk, and everybody thinks that they can pick winners in mining stocks. They can buy Newmont. They think Newmont's like Microsoft. It's not. These are speculations. You're speculating. This stuff can go south. That's one example. I can give another one. I mean, it happens all the time. That's just one example, right? It happens all the time where a company will have a problem and boom, you wake up the next day and you're down 10, 15, 20, 30% in a single day. And so Hochschild is a good example. But the other thing I want to emphasize here is that the people that were selling that stock were short-term investors. Those are the people that want returns this year. They want returns this year. And so they're like, oh, profits are down. And these are people that basically, once it's down 3%, they're out. Once it's down 5%, they're out. Once it's down 10%. So it takes a snowball effect where but there's so much short-term focus on investing. The irony is that I don't care about the next 12 months. So for me, if I was underweight Hochschild, I would have bought the stock. It was yesterday or today. I would have bought the dip if I was underweight. It was like, this is a buying opportunity, 20%, correction. Anytime, if you're a long-term investor and the story hasn't changed and the stock goes down, it's like a beautiful opportunity. I remember a couple of years ago, Hecla Mining had a strike at their Lucky Friday mine, and the stock just got creamed. I mean, it was down like 30% because of a strike. It's like investors think, what, the strike's never going to get resolved. It's unbelievable. And then as soon as it gets resolved, the stock goes right back to where it was at. It's unbelievable how. And so you need, your takeaways is that the short termers are going to really control the price. The short term investors are going to control the price, absolutely. But that price action in the short term does not indicate future returns at all. And so I'm investing for 3 years, 4 years down the road for Hochschild. I don't care about the next 12 months. So I wanted to make that point is that. And then the second company that I wanted to mention as far as news items was Aya. So Aya Gold and Silver, they did $100 million financing out of left field. Nobody expected it. They just expanded production to 8 million ounces a year. You would think their free cash flow is fine. They don't need to raise money. They're going to be able to grow organically. And they're raising 100 million and like, whoa. And so the stock price was at it. And the other thing that they did was they raised it at $1.20 below. It was priced at yesterday. So it was priced at like yesterday's closing price was like 14.35 Canadian. And they priced it at like 13.25, and it closed it at like 13.20. So their share price crashed all the way down to the financing, right? So they basically just rug pulled, their shareholders 10%, and it dropped 10% just on that financing. And what's frustrating to me is that management teams and boards will take advantage of their shareholders. They'll all have this mentality that let's borrow what we can borrow, not what we should borrow, but what we can borrow. It's like, can we borrow 100? Yeah, absolutely. Share price will go down probably 5%. Oh, the guy over in the corner knows it's going to go down 10%, but he keeps his mouth shut, right? It's only going to go down 5%. Yeah, okay, let's raise the 100 million. But what they don't realize is that they damage their shareholder base, because now people will sell the stock and they'll never go back in, and other people go, I'm not touching that stock. I don't trust the management team. So these management teams don't realize is they're damaging their base, and they're like, we don't. And then a lot of them, once they get big, they don't care about the retail base anymore. The only thing they care about is the institutional base. The institutional base is really that's where they borrow their money, it's where they raise their money. And the retail slowly gets marginalized where it doesn't even matter anymore. Like Newmont could care less about the retail base. So the bigger, and once you get above 1 billion, the retail base, this is a perfect example of a company getting to $1 billion and turning their back on the retail base. It's a perfect example. And once they get to 2, 3, 4 billion, these companies really, the hubris starts to really come out, and they really start to ignore the retail base, and they start to make decisions that are not really shareholder friendly. And then they say it's shareholder friendly when no, it's not. And so that's the pain. So we have to deal with as investors is some companies that we hold are not as shareholder friendly as we would like. And that's just go with the game. And then short-term investors, short-term traders are going to control the price. We have to deal with that. And so it's not easy. So for me, I consider this a one-time trade. I mean, it's the whole industry is gold and silver is just it's just a very messy business, if you will. It's it takes 5 to 10 years to build a mine, and then once that mine is done, it's over and done with. You got to go find another one. It's a very high risk industry, and then they basically manage it as if as if they're conservative. I mean, and then they use the printing press. It's just there's so many things that really are kind of drive you nuts. But there's no other asset class other than crypto that gives you the leverage. And I talked about Newmont being a five bagger, and it's the largest gold miner right now, and it's like that the largest gold miner is a five bagger. You got to be kidding me! And
Mm.
so that means there's 10 baggers all over the place, 10 baggers. And so you don't get that leverage anywhere else, but it's still speculating, and you got to hold your nose a lot of times. You're going to get rug pulled time and time again. And so I always say, like, if you own development stocks, prepare for you to get your heart broken. I've had my heart broken so many times on development stocks. They always break my heart. And so it's a really tough. I mean, we're speculators, so we're trying to get baggers, and most people are trying to get 10%, 10 to 20% annual returns, and we're trying to get baggers. It's a whole different attitude.
Yeah, it really is. I know that last time that we spoke, and sorry if I'm putting words in your mouth, we spoke, or you spoke quite clearly about exit strategies. Now, I appreciate that everyone's exit strategy is going to be different. And I think you said along the lines of, well, if you believe that the silver price is going to go up to a certain level, I think it might have been $80 for argument's sake, then for you that would be your point to do some movements. I just wondered if there was any change in that thesis. Does the HUI get to a certain number and then you take some profits off the table? How are you controlling that? What's your exit strategy when the time comes?
Yeah, so I think it's important to have an exit strategy. I mean, if you're holding gold and silver miners, you got to have an idea because gold and silver miners go in cycles. You can't just buy a gold mining company, even an Agnico Eagle or a Newmont, buy that company and think you're going to hold it for 10 years because this is a very cyclical business, and you could easily lose 50% of your investment. So we have to look at the cyclical nature of it. So I think the bull market just started really in gold and silver, and so it's going to run a while. So we don't have to exit, immediately. We definitely don't have to exit in 25 or 26, in my opinion. Although it's possible in 26 things could go out, could get kind of wonky, and maybe we'd take some profits, but we would only be taking profits. We wouldn't be exiting. I don't think there's any way. It's too early in the game. And so you have to have an exit strategy. For me, the way that I do that is I pick a top, and so you pick a top and then you sell to that top. So I keep raising it. I mean, I think I had my top at 2,500 when I first started doing this, and then I got to three, and then 3,500, 4,000. I keep raising it. Now my top is going all the way to 5,000. So 5,000 is kind of my exit point, but that's not where I'm going to sell everything. I will sell to the top. So now how you have to decide when you begin selling and then how aggressively you sell. So I won't sell. We'll start with gold. So I think gold is a lot easier because it's the big dog to throw a number on. So I can throw a number
Mhm.
on gold, 5,000. Silver's a lot harder to throw a target on. So what I do with silver is I actually use a range. So I take the 5,000 and I go, okay, what's the lowest GSR that I think is possible? And I think 50 is, I don't think I think 50 is easy. So that's $100 silver. 5,000. So I think $100 silver is easy. So if $100 easy, then that's not really going to be my final exit for silver. I still want to own some, but it somewhere around 75 or $80 silver. That's when I begin selling. So then
Mhm.
at the time, I'm going to have to decide how aggressively I sell So it basically ought to be selling from 75, $80 silver all the way to say 125, 150 silver. That would be the range. And then for gold, I would begin selling somewhere around possibly 3,800, but probably not. It's probably going to be between 4,000 and 5,000. And if we get to 3,800 and I have a stock that has a whole bunch of profit in it, maybe I'll sell a little bit. I'm not going to sell it all, but maybe I'll sell half of one
Hmm.
just because, we have a lot of profit. But more likely, I'll probably won't begin until $4,000 gold. And then from 4,000 to 5,000, I'll steadily take stuff off the table. So at 4,500, I would expect to have sold half of my gold miners, for instance. And so you want to sell the ones that do the best. So at $4,500 gold, I'm going to look, which stocks are 5+ baggers that have a whole bunch of profit in them, and probably, sell half, and then let the rest of it ride with like a 25% trailing stop. That would be one way to do it. And so, but then once we get to $5,000 gold, I'm probably going to sell everything, all my miners, except for a few development stories that need to build mines. So if we're at $5,000 gold and there's still a couple projects out there, because the way that gold and silver work, these companies won't get re-rated higher until they put a mine in production, and then they do the first quarter of and they prove that they're going to hit their target.
Hmm.
So you got to wait till the mine's built. And so there will be a few development plays that I'll hold for that and wait for them to get re-rated higher. Although if we're in a mania, I mean, if silver's over 100 bucks and we're in a mania, and these stocks are basically already getting kind of re-rated higher. In other words, they're silly valuations. Then I might exit. But if I feel a stock's going to go up another 100%, I might hold it. Maybe there's a half a dozen stocks I hold on to beyond $5,000 gold, maybe, or I exit everything at $5,000 gold. One point I want to make here is that this has always been a trade for me. So I've always planned on basically selling to the top of basically what's happening politically in America, politically and economic in America. So that's the reason why I got into gold and silver. It's what's happening today in America. In other words, I saw that coming. So I'm like, okay, if this is our economic system and this is our political system, we're in big trouble. And so I'm like, okay, I know how this story ends. I
Hmm.
know how this story ends. And now it's becoming obvious to other people, not everyone, but it's becoming more and more obvious to other people how this story ends. And the way that it ends is we default on our debt. And Besant just came out and said that we won't default on our debt. And treasury secretaries and Fed chairmans, they always say that we're not going to default on our debt. We're not going to default on debt. Well, what's the old saying? It's not true until they say it. Well, this is a good example. Now you know it's going to happen, right?
Yeah.
Yes, we are going to default on our debt. The question is how much are we going to default? I don't think we'll default on 100%, but maybe 50 or 70% we'll probably default on.
I think through all of that, I think if I was giving a point to people to take away, and you can say something different if you like, would be to have that exit strategy in mind. What works for you. Do you follow what Don does, or do you say, if it gets to X amount, then that's it? I would say it's important that if you are investing in mining stocks and so forth, have an exit plan in place, and then that way you're not going to get caught up in the emotion of all these price swings that we're very likely going to see moving forward.
Yeah, absolutely. Yeah, a lot of people are going to sell too early. One of the things I keep telling people. So I created a list called the Mormons back in November of 23, and that's the reason why they're called the Mormons is because you're not supposed to marry stocks, but these are the
Mhm.
8 prettiest silver stocks. You can marry all 8 of them, so I call them the Mormons. And those 8 stocks, you don't want to sell those stocks early. And so I've been telling people on Twitter, because a lot of people are going to sell them too early, because this silver, like I said, $100 silver is easy. So there's going to be people that buy now and they get out at like 50. A lot of people are going to be getting out because their stocks are going to be up 200%. And people
Mm.
don't know, people don't understand how, they don't know how to handle a 200% return. I have a stock that has a 2,000% return. It's like, and I haven't taken any profits in it. And so it's like, you don't want, even if a stock has 200, 300, 400, 500, you don't want to sell early if it's still got more room, it's still got more room to go. So a lot of people are going to be selling early. I always say don't sell any of these Mormons until $75 silver. That would be the earliest, 75, 80. That's kind of like, that's kind of the first time to take any profits, I think. And so it depends how fast we get to 75, how much momentum there is, the whole fundamentals of silver. But we get to 75. I actually think when we get to 75, that the fundamentals of silver will be better then than they are now. And the reason why I believe they'll be better then is because there won't be any. We'll be experiencing shortages of silver, shortages of 1,000 ounce bars. You won't be able to find silver locally. You won't be able to find silver on the internet, which is kind of crazy. They'll all be sold out. The only place you'll be able to buy it, you'll be able to order it. That's it. You'll be able to go to these websites and order it. And they're like, okay, we'll lock you in a price and we'll give it to you. You'll get it in 30, 60, 90 days. You can order it. That's what's going to happen. And that's when the fundamentals really start to improve. And I think we're going to have shortages in 1,000 ounce bars. So we've been having deficits of 100 to 200 million ounces a year. Those
Mhm.
deficits is above ground silver inventory that's basically going to these fabricators, or they're going into ETFs. And so that inventory, that above ground inventory, is slowly whittling away. And I really believe it's gonna go to zero. And when 1,000 ounce bars go to zero, and I'm talking about available inventory for purchase. So let's say that you're a contractor for Apple and you make their phones and you need 1,000 ounce bars. You're probably going to have a few pallets of them, and you don't order them, I don't know, monthly. You probably order them quarterly or something. But they're going to go to order some and they're going to be out and they're going to go, oh, we can't find any
Mhm.
silver. That's going to happen, I believe. And I think it's going to happen before $75 silver. So we get to $75 silver and all the fundamentals are going to be getting better and better and better. And you're going to go, I'm sure glad I didn't sell at $50 silver. I think that's going to be the takeaway is when we get to 70, $75 silver, the people that didn't sell are going to be very happy that they held. That's my, I always say, people say that it's never a bad thing to take a profit. I disagree. I think there's such things as bad sells. If you sell, and a perfect example is Bitcoin. I
Mhm.
mean, if you sold your Bitcoin, that was a bad sell. I don't care if you made profit. It was a bad, bad sell, right? If you sold your Bitcoin like before $10,000 and you made some profit, that's a bad sell. And I think it's the same thing it's going to be with silver miners. When you leave that much money on the table, it's not a smart move.
No, that's perfectly understandable. Just the one thing that I wanted to touch upon before we wrap up was we've mentioned the GSR, the gold silver ratio, a few times throughout this podcast, and I think we're in the same boat where we believe it's going to go much lower. I mean, at the moment, it's sitting around, I'm going to say 91, 92. It has been higher before. It's got up to, over 120. Recently, it's been above 100. You've said a couple of times already today, you believe that getting down to 50 to 1 should be relatively straightforward. How low do you think it could go? And is that just as a result of gold moving to, say, 5,000 and silver has to play catch up? Or are there any other reasons why you think that ratio should go lower?
Well, the first thing I want to clarify is that the skeptics think that the GSR the squeezing of the GSR has no basis in fact. that in actuality, the GSR could go higher. There's people out there that are GSR skeptics, if you will, but they're ignoring history. And what history tells us is that whenever silver becomes a proxy to gold, you get a squeeze. And silver becomes a proxy to silver only when you get economic turmoil and you get a fear trade. It's the only time. So we had the GSR squeeze to 16 or 17, I think it was 17 in 1980. Now they had the Hunt brothers. You could make an argument that was oversold, all the way down to 17, but it still would have gotten the 30s, I believe. Without the
Mhm.
Hunt brothers, I think it would have gotten in the 30s. You had people lining up in 1980s. You had people lining up to buy silver. That's proxy. That's a proxy to gold. And the same thing happened in 2011. You had the GSR squeeze all the way down to 39, and that was a very short period, 6 months.
Mhm.
So, and that was a proxy. So when people want to buy gold for fear, they also want to buy, they can't afford gold. So the average retail person doesn't have $3,000, $3,500 lying around to go buy an ounce of gold. They don't have it. But guess what? They have $500.
Mhm.
They have 500. Well, guess what you can do with 500? You can buy silver with 500. And so that's what the proxy is. So people buy physical silver as a proxy to gold. That's the reason why you get the GSR. It's basically a run on physical silver because that's when the fear trade, people want to buy it. So getting the GSR to 50 is easy. You watch how fast when silver goes to $50, the GSR will go to in the low 70s or maybe even the 60s because silver will outperform gold that quickly. It'll just go zippity doodah from 30 to 50. And so if you do $3,500 gold divided by 50 is 70. So you get a
Mhm.
70 GSR at $50 silver if gold doesn't get above 3,500. So I think that's what we're going to get. We're going to get a 70 GSR at $50 silver. And then silver is just going to keep outperforming gold. It's not going to stop there. It's just going to keep outperforming gold and the GSR will squeeze. And that's when you get into 60s fairly quickly, get to low 60s, and it just keeps going and going and going. Um, so that's my expectation. But I mean, if you wanted to be really uber conservative, you use 70 as a GSR if you want to be uber conservative. But you asked me how low it could go. I think it could go in the 20s. Some people think it could go sub 20. I'm not in that camp. I
Mhm.
think sub 20s is kind of, you know, pretty extreme.
Mhm.
But I do think 20s are in play and 30s. I think we can expect 30s. I really do. But if you get 33 on the GSR at $5,000 gold, it goes to 150. Let me repeat that. Gold goes to 5,000 and the GSR squeezes to 33. Silver goes to 150. I don't even try to do um, value my silver miners at 150. I don't even
Mhm.
do it at 125. I use 100. At 100, the Mormons average about an eight bagger. At 150, you're talking 15 baggers for the Mormons. I mean, that means the juniors, you're going to see juniors, if that happens, the juniors, they're going to be life changing to some people on some of these juniors. If you're getting that kind, if we do get a GSR 33, I mean, we're looking at some really, it's hard for me to wrap my head around this stuff. But when I look at the price of gold and I look at the environment, the macro environment, I really don't see a scenario where we don't get to 4,500. And so if 4,500 is easy, which I think it is, then that puts 5,000 in play. That's the way I look at it. 5,000 is in play.
Yeah, there's so much economic, well, there are so many economic issues and financial issues and things at play at the moment where I'm in the same camp as you. I think $5,000 gold is going to be a piece of cake. to be
Piece
perfectly
of
honest.
cake.
Yeah, I really do, and I don't just say that to be clickbaity or anything like that. I just think you just got to look at the numbers, which is what I would urge people go and do, and that is to follow you because I your work is incredibly in depth in terms of analysis and numbers. And if people want to follow you, again, I'll put links to all of this in the show notes. It's Don Durrett, that's DURRETT.substack.com. And then over at X, it's Don Durrett as well. Don's newsletter on Substack as well. Highly recommend you give that a follow and subscribe. Is there anything we haven't discussed today that you would like to finish up on, Don?
Yeah, let's kind of finish here on Trump's tariffs. Because I think this is really important because people are wondering, people are always wondering where gold is going and silver is going in the near term. Do I buy miners now or do I wait? People are always thinking about this. And today's Wednesday. I do a Wednesday, a midweek recap, and then I do a Friday macro. And I'm going to do this until, I don't know, until we really break out, and then I'll probably just do Friday macro. Right now, I'm doing twice a week because people are really interested in this information. But I really believe that the economy has been slowing. The Fed raised rates, all the way up to 5%, and it really hasn't. It hasn't caused a recession. It hasn't caused, the stock market's 3%. We really haven't had this lag effect that you normally get when they raise rates where the economy slows. And I think it's because of fiscal dominance, where we have these $2 trillion deficits. And these transfer payments from the government are basically, creating QE, if you will, injecting liquidity into the system. But I think the economy has been slowing through this lag effect. We're seeing kind of a slowdown in autos and a slowdown in housing, and consumer spending, I think, is being impacted, especially on the lower end. I think the economy is slowing, and that Trump isn't really stimulating, but his economic plan isn't really stimulating, if we look forward here, because the tax cuts that he's doing are not really tax cuts. All he's doing is extending what currently already exists. So he's doing a little bit of spending, if you will. He's not really doing tax cuts, but he's not doing very much spending where it would stimulate. In other words, the only way you can really get stimulus from Trump is maybe if he does some regulatory stuff. But the problem is, last time when he came into office, he did these tax cuts, which were stimulative. So he's not really doing stimulative. He's doing the opposite of stimulation, which are tariffs. Tariffs are a tax increase. And some are saying it's the highest tax increase of the middle class in 20 years or something. So the middle class is going to bear the brunt of this. I mean, the upper class can afford it, right? But the middle class, they're the ones that are having trouble with their budgets, right? And tariffs are going to increase our cost. That's inevitable. Now, when Trump came into office, so he's slowing the economy is slowing, and he's putting tariffs on, and everybody seemed to think that somehow he's going to be able to, avoid a recession. And I'm saying that I don't see any way that's going to happen. I really believe we're going to get a crash in the stock market and get a recession. And I think it's around the corner. Maybe we have to go all the way to the fall, but I just think that it's a train wreck dead ahead. I could be wrong, but me watching this economy on a daily basis for the last 10 plus years tells me that tariffs are basically really bad medicine for an economy that's slowing. And we are completely fooling ourselves if we think that the economy is basically going to be able to just handle these tariffs with no problem, and the economy is just going to keep muddling on, and the stock market is going to go higher. I don't see that as an outcome. So for me, I think a dip in the stock market and a dip in the miners is right around the corner. I'm waiting for it. I'm looking forward to it. I'm on the sidelines here, waiting. Well, I'm pretty much fully invested, but I didn't buy any stocks this month. I'm not going to buy, probably not, next month. My cash is adding up, if you will. And I have 5 or 10 stocks that I like to buy. I probably won't be able to buy them all, but I'm thinking I should be able to buy about 5 of them um, when this next dip comes. So I'm actually very excited. I always say that the reason why I've been successful investing is because I buy dips. That's how I focus. Entry is everything, right? So I'm
Mhm.
always trying to find stocks that are cheap on sale, and the best time to buy a stock on sale is when you get a big dip. So like Hochschild today, that was probably um, maybe not a bottom, but close to one. If you can get close to a bottom, that's about as good as you can do. But I told you the bottom was back in February of last year,
Yeah.
24. Those were the bottoms. So we missed those. Most people miss those bottoms, but there are still a lot of stocks that are still super cheap. A lot of development stories that are really, really cheap. And so those are still on sale, and I think they'll get a little cheaper here in the next few months or the next month. So thanks, Robert.
No, Don, no problem at all. Plenty to watch out for. And again, I would say that people should go ahead and head over to goldstockdata.com, follow Don's newsletter over at Substack, also follow Don on X as well. I will put all of those links into the post that comes with this podcast as well. Don, a pleasure as always, and plenty to talk about, and look forward to catching up again in due course.
Thank you, Robert.